Hello, my name is Jonas Thulin. I'm head of asset management here at Erik Penser Bank, and I will try as short as possible to explain what we do in the portfolios, what's happening in the market, what we're looking at and what we're not looking at. Today, it's Monday today, and we have various statements out from both from Moscow and Ukraine and the US, so it's a little bit of a complex picture. So right now we're in this very challenging but also very interesting mode where we try to handle short-term volatility and risks that could potentially mean something as nasty as a war, and also a fundamental view on the strategic asset allocation and trying to make that balance to work. That means that we can't be fully open with what we're doing in the portfolios now due to regulatory demands basically, but we are working intensely in the portfolios right now in order to keep risk as much as possible. We still overweight equities. But obviously we need to have some kind of hedges that can come into play if things were to turn south aggressively. Our aim is still to beat global benchmark in terms of equities, both on a sustainable and less sustainable global equity portfolios that we have. And we're sort of making a slight comeback right now. We're not at all satisfied with this, but we try to handle risk and keep the downside protected whilst trying to add as much potential upside as possible. The methodology is still the same. We still use a lot of theorems, a lot of quant, and I will show the first time we show actually one of our equity buying models, but the underlying methodology is still the same, of course. The house view is pretty much the same as well. Now that might sound weird, but the fact is that we are still overweight equities, a little bit less than a week ago. We keep some overlay hedges. We will not change too much, but we will work every single day with adjusting risks in terms of the development in Ukraine and stay, as I write here, very, very agile. But we still believe that we're in a strong business cycle. Hence, we're not in the mood that we want to chuck out equities entirely, given the fact that we are still in a very strong business cycle, we're still in a very strong earnings cycle, and I'll show some more data on how we view this. So it's a neat little balance that we're trying to create right now, basically. One of the reasons why we keep on hanging on to a largely overweight position in the equities is that we still don't see the vol in a portfolio that would necessitate or demand further action, basically. When our blue bars hits below the one standard deviation, we have a firm signal to act strongly in the portfolios. We're not there now, and we're quite far from it actually, which means that even though we can be all concerned, the actual vol or the actual fallout from the equity market as handled in our portfolios hasn't been that big enough so that sort of corresponds or means that we're going to adjust risks more than we have had, basically. Now, given the risk, we run various risk models. This is one that we completely could ignore at the end of 2021, given the fact that this fallout in risk here was very euro-denominated and emerging market denominated. As we have no equities there, we could simply just cruise along. This time around, it's more of a US concern. Hence, we have had to work a bit more in the portfolios. As you have seen, we have added banks, real estate, energy. We kept overlay hedges, and as I hinted, we're also looking into increasing those, given the news that we saw over the weekend from Ukraine. So we're keeping our weight, but we have taken the edges of it, basically. What is important for us is that the intermarket risk is contained. Basically, I don't know how to express it. I mean, we're not okay with volatility in that sense, but it's one thing that the market spot is volatile. It's another thing if the internal market becomes less liquid, i.e. the price of dollar liquidity goes up or interbank spreads move, etc., etc. That would be a much more deteriorating environment for us than we're seeing today, which is, at the end of the day, very, very positive. It's even so that we, on the 24th of January, said there was a 96% chance of an equity bounce, and on the 25th it was 100%. And the reason is this little blue line, the blue model. I mean, you can criticize me if you want, but I've hidden the axis here because we don't want people to copy this. It's not too tricky to build. Basically, when the blue line breaks the threshold or signal barrier, we have since 30 years, going back 30 years, 100% hit rate on buying equities on that day. And also in the corresponding 6 months after this, we have a 9% positive return. We saw that on the 25th of January, which is why we hang on to equities. It will be interesting to see what happens now, but at least there were some signs that the market was ready to go on full on in equities that we want to listen to and not disregard entirely. Now, the thing that makes this whole week a bit tricky is that we have an option expiry on this Friday. We all know what happens with gamma and positive and negative gamma. We have had a very, very tremendous and tough January with 2 episodes with deep troughs in negative gamma. In our model, we should experience positive gamma going further out and forward in terms of calendars into February, March. But obviously, with an option expiry on Friday, we have Ukraine. Mix that with people that just jumped on the bandwagon into the equity market, which is what has happened. It becomes a little bit challenging and also very, very interesting. For us, when we look at the gamma, and IE will probably be next week's agenda with a turnaround Tuesday, as we have to wait for the option expiry this Friday, it becomes very interesting to try to hold on to risk, but manage risk, given the fact that we don't know what would happen in the Ukraine. It's a too big a risk to ignore, we think. So we have to be clever about that. That's the work we're doing right now in the portfolio, and I will go through a bit more in detail next week, but we can't really say much more than that today. The underlying business cycle is very supportive of equity markets, which is quite important. This is built on some 4,000 data series. We are concerned when the macro slumps, we lose momentum. We're not there yet, or we're not there now, which is of course fundamentally positive for the equity market. Econometrically, that means that every dip you see, well, you should, to be perfectly honest, you should calculate the spread between the equity market and the GDP, and then you can actually build up a statistical signal for when to increase your long positions or get out of your long positions. I'm not showing that here. It's just sufficient to say that you shouldn't get out on the equity market based on business cycle reasons or earnings reasons. Now, the yield move is benign. We can talk all we want about it, 2% on the 10-year yield in the US, but still the momentum and the speed and the actual push or upwards in yields is benign, and it's not a threat to the equity market as such, which is an important signal for us. It's even so, and I know that I'm sticking my neck out here a bit, that at least in Sweden we had a lot of discussions that, or some had a lot of discussions that CPI was a concern in January, and that's why the equity market fell off the bandwagon. Obviously that's not true. Today the CPI or priced CPI or rates even explain about 10% of the equity move if you look back a month. Political risk explains about 75–78%. So clearly we're sitting in the lap or on the knee of political risk here. Political risk is something that we don't really discuss much in Sweden anymore after Trump lost to Biden. But the fact that when Biden lost the national post to Trump, that's exactly when we saw this huge shift in political risk. That is the main story for January, not CPI, etc. As such, the trajectory or future of political risk, which we think is positive actually, after taking this initial shock, is quite important for the equity market. The other thing that we want to highlight is that the business cycle is still supportive for earnings revisions. Earnings revisions are important as they lead the equity market, don't really lead EPSs. You have always to work around these things a little bit, but it's quite interesting to follow earnings revisions here in black and just plot it against surprise indices. What we would like to sort of add on to the argument is that when we reach these 2 blue bars or lines, that's when we actually see equity weakness on a material stage. And also surprise indices from Citi, for example, they do tend to measure the economic surprises through FX spot reaction on the data rather than actually measuring the data versus consensus. So we like to measure economic surprises both from a market perspective but also from a fundamental perspective versus consensus. You have 2 of those versions here on the graph. Neither one of them is making the argument that earnings revisions should be turned negative. And that is of course positive. And also remember, it's not enough that earnings revisions turn negative. They have to turn quite negatively in order to start to threaten equities. So far, earnings business cycle is still supportive of equities, which is important for us when we look at current risks and how to treat those. In terms of data for the week, we are happy to note that we were number 8 in the world on Bloomberg on ISM and number 2 on US GDP. And for this week, it's more about leading indices and retail sales in the US, if anything. Now, leading indices in the US are super strong, of course. We are on the double growth rate that we were before the pandemic, i.e. for us that means a super cycle. This type of very positive way of looking at the US has earned us a number 2 spot on predicting US GDP, which we're quite happy with. And we're going to stick to that until the data shows us otherwise. And it's not for the time being. Retail sales, we think it's going to rebound. We have a daily updated retail sales model, which actually is a lot neater than this one because it looks a little bit chaotic here during the post-pandemic period. I'm not showing that one. I'm keeping that a bit close to the chest. It's enough to say that 1.5 or 1.2% is actually on the lower end of what we get from those models, but that we're going to see rebound is for us certain. Now, Swedish CPI will probably start to roll over, which we think is quite interesting. Remember, one of the biggest hedges that we have is an open FX risk between dollar and Swedish krona. And we're sticking to that, obviously, this week when there's so much volatility coming from Ukraine. And given the financial stress the market is viewing or assuming is happening in Sweden, it's a quite neat exposure to have as well. If CPIF starts to roll over, given all the forecast, that would be great too. If not, then we can certainly hang on for another month. The GDP outlook in Sweden is back to where we were pre-pandemic, i.e. 2.5% on a year-on-year basis. In the US, we're sort of plateauing around 5%, which is of course a lot better. Now, naively speaking, it's not too surprising for us that earnings revisions, GDP momentum, capital flows are more supportive of US equities than Swedish for the time being. A little bit of a no-brainer in that sense, but we think there are some fundamental reasons why that happens. Unfortunately, if you invest in Swedish equity markets, or a little bit less unfortunate if you're invested in global equities, unhedged in dollars especially. Now, the recession risk in the US is 13.1%. That's what's priced in the market. It's moving up. So it's I shouldn't perhaps overdo the importance of the second derivative there, but nevertheless, it's still quite low from a historical perspective. Now, the financial conditions in the US, you could argue, given the vol that we've seen, it probably should have come down a bit further, but it's still supportive, and that's important given the fact that we're taking so much pricing on the Fed already. Financial conditions in Europe is a heck of a lot worse. No news here. We're still over at the US. We have very little equities in the euro area. I should mention on the left-hand side, you actually see the Fed research way of calculating financial conditions. On the right-hand side, you see the ECB's. So it's not up to us really or of course it's up to us to define how we do this, but these are standardized measurements. Now, in terms of the Fed, we think it's quite interesting to see the kind of jinx that we put in on the Fed fund futures. We think this is quite natural, that we're just about to start a hiking cycle. The Fed is constantly out there testing the market, if we're being dovish or hawkish. If we're going to go out and say we're going to do 50, or we're going to do 5 or 6 hikes, and then they're going to revert it all back and say that it's going to take 2 years before the labor market gap is closed, and we're not going to be that hawkish, we're going to be a bit more slowly. So the market shifts the Fed fund futures curve constantly. But it's quite interesting that, as many times before, we priced in a cut even before we even started the first hike. I.e. the market doesn't buy into the fact that we're going to see these hikes materialize as we move through 2022, 2023, 2024, which is, sort of makes sense in that sense, really. The key behind all this is, of course, if the hikes will lead to recession risk in the US. There are no signs of that as of yet. Obviously, of course, we haven't started hiking, but at least we've priced it into the Fed fund futures. But this is a key going forward, to what extent will actually hikes be priced into what effect will it have on the business cycle indicators. Now, this is just a sad picture on Sweden in terms of our systematic stress. Nothing really has happened since last week. We can sort of skip this, but our strategy is quite clear in terms of the stocky. And we want to round off with the CPI. Because the way we track price CPI, we look at it on traded and priced inflation expectations. We look on break-evens in various sorts and inflation swaps. We look at commodities, and all these are perfectly aligned with the peak in inflation happened in Q4 2021. Since then, the whole supply chain argument has completely dissolved. I shouldn't say the supply chains have dissolved and the bottlenecks, but the argument has started to dissolve quite rapidly. The linkage between CPI and the markets is quite questionable and debatable, at least from a pure math point of view. But it's also quite interesting that the market is pricing in lower and lower inflation. Is it transitory? I don't take too much regard in the choice of words here, but at least what you can lean back and say quite relaxed is that if the Fed wants to stop hiking and take their time, it sort of makes perfect sense, as you can already see the peak in priced inflation. They will hike, but we think they're going to hike 3 times this year, which of course is a bit less than the market. So I'm going to stop there with a very short and brief update. Of course, a lot of focus right now is on how to handle the situation in Ukraine and the vol and the scariness that goes on. I shouldn't say scaremongering, but there are a lot of discussions going on. And we are certainly handling in the portfolios, but we're also making sure that we don't lose sight of the bigger picture, which is still very, very supportive earnings outlook, very, very supportive business cycle outlook. And yes, we can see the Fed will hike rates, but it's not enough yet to sort of really challenge the financial conditions or the recessionary outlook in any shape, size or form. Therefore, we're sticking to an overweight in equities, even though we are right now increasing our hedges a little bit. With that, I thank you so much, and I look forward to see you next week.